Are index funds 100% risk-free and safe? Can index fund give negative returns? Will index fund give index return or lesser return than the index? Does index fund take calculated risk or just blind risk? Is index fund the best way to create wealth in the long run? You can discover answers to all these questions in this video. Index fund is stock market. A stock market is riskier. It can go down. Index fund can also go down. It also has got risk involved in it. There are different types of risks in index funds. Let us see them one by one. The first risk in index funds is short-term volatility. End of the day, index funds are going to invest your money in equity, in the underlying stocks of the index. So if the stock market crashes or goes through a correction, or if the economy goes through a recession, obviously the index fund value will also go down. It will also give you negative return. There is no doubt about it. In the year 2020, 2008, in the year 2000, when the market corrected heavily from 30 to 55 percentage, index funds also went down by 30 to 55 percentage. So even index funds will give you negative return. There is no doubt about it. The second important risk with index fund is index fund delivers lesser return than the respective index. We normally expect an index fund to deliver index return, the return that's equivalent of index, but in reality an index fund delivers less than index return. There are two reasons behind it. One is expense ratio and the other one is tracking error. In the index fund, though the fund manager will not do any analysis about the securities, still there are fund management charges. There is an expense ratio which will be internally charged on the NAV, which will reduce your overall return. Let us say between 2013 to 2023, 10 year of investments, Sensex has delivered 12.5% return. Nifty has delivered 12.6% CAGR. But someone could have invested in an index fund which is following Sensex or Nifty. They could not have reaped 12.5% CAGR or 12.6% CAGR. It will be slightly lesser than this 12.5% or 12.6%. It will be something like 11.75% or 12%. As I told, the first reason for lower return in index funds compared to the index return is expense ratio. Second reason is tracking error. The job of an index fund is to cut copy paste the index, but there is a small practical problem in doing this cut copy paste. Let us say an index replaces one of its stocks. For index it's just an entry. It removes stock A and replaces it with stock B. Whereas in an index fund, a stock A was already there. Crores of money got invested in stock A. Now, as the index is replacing this stock A with stock B, as a fund manager, you are supposed to sell stock A and buy stock B. But stock A's worth in your portfolio is in crores. So you can't sell it all of a sudden. You have to sell in a staggered manner, maybe for a week's time. Then you will slowly buy stock B. Because of this, there will be a small tracking error. This tracking error and expense ratio will reduce the index fund's return marginally. That is why 99% of the times index funds will deliver lesser than index returns. Third important risk with an index fund is it is blind to risk. Index funds will not take a calculated risk. Index funds will always take a blind risk. When an index fund manager invests in a portfolio, he will simply cut copy paste the entire index portfolio. All the stocks in the index in the same weightage. He will not apply any logic. He will not do analysis on the underlying stocks. He will not look at the balance sheet, profitability, sustainability, market share. He will not look at anything. Even if he has a negative opinion about one of the stocks in the index, even then he is forced to own that stock in his portfolio. No other go. So here the fund manager blindly takes risk. He is not at all taking calculated risk. Investing is all about taking calculated risk, optimizing risk. This risk optimization is not at all addressed in index fund. The fourth important risk with index fund is no flexibility and no dynamism. Normally in a diversified equity fund, the fund manager will analyze all the sectors and he will be making a forecast. Based on his forecast, he will find outlook for a few sectors very bright. He will have much higher exposure in his portfolio for those sectors where the outlook is bright. Where the outlook seems to be dull, he will not have any exposure, or he will have very less exposure. He can change this exposure, he can rotate sectors in his portfolio based on how outlook changes over a period of time. This is flexibility in management. Similarly, he can also have outlook on capitalization. When the market is at peak, he may decide to invest in large cap as defensive stocks. When the market is at the bottom after a crash, he may move from large cap to mid cap and small cap. So it depends upon outlook and opportunities available in the market. He can change the allocation dynamically in a diversified equity fund. In an index fund, it is not possible. Whatever the allocation, whatever the sector allocation that is there, whatever the capitalization allocation which is there in the index, that needs to be blindly followed and mimicked by the fund manager. So there is no dynamism, there is no flexibility in the index fund management. The fifth important risk with index fund, it is index funds are designed in such a way that they will buy high and sell low. The basic investment strategy is to buy low and sell high, whereas the index funds operate completely against this principle. Let us say a stock is to be replaced in the index. Most of the analysts will be knowing about that couple of months in advance. So they will sell stock A, which is going to be getting replaced, and stock B, which is going to get into the index. They will start selling stock A and stock B in advance. But whereas in the index fund, the fund manager will not do that immediately. He will wait for the deadline date. Only after that he can sell stock A. By the time, most of the people in the market could have started selling stock A. Because of that, stock price could have come down already. So he is actually selling low. Before the deadline itself, most of the people could have started buying stock B because they know that it is going to get into the index. So because there are more people who are buying that stock, demand is high, the price could have gone up. Index funds will buy those stocks only on the deadline date or after the deadline date. Because of that, again they will end up buying high. This is completely against the basic investment principle of buying low and selling high. They actually sell low and buy high. Even during the 2023 Adani Hindenburg report episode, during that episode, most of the index funds suffered because in 2021 itself, Adani stock prices were extremely at overvaluation. Most of the fund managers started selling those stocks. Active fund managers, they have sold it. Whereas in the index fund, though the fund manager knows that the stock is pricey, it is overpriced, he is forced to continue invested in those stocks because it is part of index. Only if the index kicks that stock out, the fund manager can sell. Otherwise, his hands are tied. He has to invest in those stocks. He is forced to invest in Adani stocks. When the Hindenburg report came out, Adani stock price went down heavily. Actively managed funds who sold those stocks at a better rate, they have saved investors' money. Whereas in the index funds, there is no option. Adani stock price went down. So as part of index, Adani stock price went down. So index funds value went down. Index fund investors actually suffered a lot. So index funds has a huge risk of buying high and selling low, which is against the basic investment principle. The sixth important risk with index fund is there is lack of downside risk protection. Whereas in the actively managed fund, when the market is bullish and its peak overvalued, the fund manager can change the portfolio to defensive stocks so that downside protection happens there. Whereas in an index fund, even when the market is bullish, peak, overvalued, he should be 100% invested simply. No downside risk protection technique can be applied. Similarly, when the market is bearish at the bottom, completely undervalued, normally in the actively managed fund, the fund manager will change the portfolio to momentum stocks, stocks which are going to unlock the value quickly so that he can capture the upside better. It is not possible with an index fund. The fund manager has to simply invest in all the index stocks in the same proportion. So there is no downside risk protection in an index fund. Seventh risk, index funds will not beat the market. Index funds will not generate any additional return than the index. They can't give more return than the index. Whereas the actively managed funds will apply a lot of strategies to generate alpha. Alpha means additional returns than the index returns. They will do it by doing stock selection, sector rotation. Many other strategies are there to generate these kind of returns. We have done a well detailed analysis on actively managed funds as well as passively managed funds returns from different categories. It is available as a blog post. It is also available as a YouTube video. It's a well detailed research. All the numbers are available. You can check. I'll give the links for the blog post and YouTube channel in the description. In all the categories, actively managed funds are doing well. Whereas in the large cap category, close to 60% of the large cap funds are doing well compared to the index. In mid cap category, most of the mid cap funds are outperforming the index. Whereas in the small cap category, almost all the funds are outperforming the index. So flexi cap and multi cap category also outperforming the respective index easily. There's a huge margin between index fund and actively managed fund. So investors should not miss those kind of returns. If you have a trustworthy financial planner or a mutual fund distributor who's capable of selecting an actively managed fund which can outperform the index, then please take help from him and invest through him so that you will be able to beat the index. If you don't have a trustworthy financial planner or a mutual fund distributor who can help you select good actively managed equity fund, then it's a small handicap for you. You may have to settle for an index fund. Though index funds has these many risks involved in it, why index funds are so popular? Why index funds are most talked topic in social media? In a developed market like US and UK, index funds are really attractive because in a developed market it is difficult for an actively managed fund to outperform the index because the market is more matured, market is well developed, everything is transparent. So all the information is already factored into the price there. So it is difficult for a fund manager to identify a stock which is undervalued there. That is why index investing is so popular in a developed market. Whereas in a developing economy like India, the market is not matured, market is not well developed, and it is not very transparent. All the information is not factored into the price. That is why even in a large cap stock, a well known stock, which will be followed by most of the analysts in the market, you can find it at an undervalued rate, at a discounted rate. Say for example, in the year 2020, ITC as a stock was quoting at 160 rupees when the Sensex was at 28,000 levels. Subsequently, when the index moved up from 28,000 levels to 60,000 levels in 2021 October, means index has doubled, whereas ITC stock price went up from 160 to 200, which is just 20% return, whereas index delivered more than 100% return. ITC, large cap stock, part of Sensex, part of Nifty, 100-year stock. Most of the analysts analyze this stock. This is not a small cap, micro cap, tiny stock which goes unnoticed. No, well-known stock, but it is available at an undervaluation for a much longer time frame. From 2021 October to 2023 September, market was kind of flat. It didn't go up. It was at the same 60,000 levels. But ITC went up from 200 to 450. A fund manager who identified this stock at that level and stick to that stock was able to generate additional alpha for investors. That is the beauty of actively managed fund investing style. There is a huge opportunity in India for actively managed funds. Till it becomes a developed market, matured market, more transparent market, as an investor you have to take advantage of that. Though actively managed funds has a higher expense ratio, over and above the expense ratio they have delivered additional return which has beaten the index return. So over and above the additional expense ratio, over and above the index returns, these actively managed funds are capable of delivering additional returns. In social media, people advocate for index funds and they de-sell or will not recommend actively managed funds because index funds has got low expense ratio, whereas actively managed funds has got higher expense ratio. See, the NAV declared both in index fund as well as actively managed funds are post expenses. So there is no reason a person should consider just an expense ratio for selecting a fund. Compare the returns. Again, like go back to the links which is given in the description. The comparative analysis of actively managed fund returns and passively managed funds in the blog post as well as in the YouTube video. You will see clear facts, complete facts. At what margin actively managed funds are outperforming the index funds. You will know very clearly. At the same time, to what extent index funds are underperforming the respective index because of expense ratio and tracking error, you will know. Most of the not SEBI approved but social media influencers who are active in the personal finance space recommend index funds, saying that it is riskier for the investor to pay additional expense for an actively managed fund. When you are investing through an actively managed fund manager, the fund manager may not beat the index, so there is a risk. This is what they claim. Agreed, right? When you are investing in index fund, you will get almost similar to index fund returns. But at the same time, in the same social media influencer will say, boss, invest in index funds, but at the same time, you can buy my stock recommendation package, which will help you generate much higher return than the index. One side he tells your fund manager will not be able to outbeat the index, so pay less expense ratio and settle for index funds. On the other side, he claims he can outbeat the index when you buy his stock recommendation package. So there seems to be some conflict of interest here that as an investor you should be cognizant about it. Fund managers are well qualified and they are also well regulated by SEBI, and they have a team of people, they have research analysts working for them. With the help of them, they are able to manage the fund, outbeat the index. At the same time, social media influencers are not well qualified, not SEBI approved, but they claim they can outperform the fund managers. So please buy my stock recommendation package. What's the logic? You have to just think about it. Is it possible for an unauthorized, not SEBI approved social media influencer to outperform a mutual fund manager? That you have to just think. What's the logic? They say a fund manager cannot outbid, but I can outbid, so buy my package. So if you could understand the logic, please share it in the comment section. So I would strongly suggest rely on the process, rely on the investment process, rely on the regulation, and choose an actively managed fund. If you have any questions related to index funds versus actively managed funds, feel free to share it in the comment section. I'll again meet you in yet another video. If you have any questions on this policy or any other investment options, feel free to book an appointment with our financial planner. The registration link for booking the appointment is given below this video in the description box. Would you like to attend insightful investment webinars which can help you to create wealth and achieve your financial goals? We organize regular free investment webinars. The registration link for the upcoming webinar is given below this video in the description box. Please click and register yourself so that you can learn the techniques to create wealth and reach your financial goals faster and smarter. Please subscribe to our YouTube channel so that you will not miss any of our future videos. If you like this video, please give a thumbs up, and if you have anyone in your social circle who will be interested in this video, please share it with them. Thank you. Bye.